Let's bring in the aforementioned pioneer of the bond vigilante term, Ed Yardeni, the president of Yardeni Research. Ed, this is an environment where it's surfacing again, that term, bond vigilantes, but they don't seem to be nearly as effective of vigilantism as the original bond vigilantes that helped you coin the phrase.
Correct. Well, they were most active in the 1980s, and then in the 1990s, inflation came down, and the administration back then, the Clinton administration, recognized the power of the bond market, and they actually maintained fiscal discipline. This time around, the concern is, of course, that deficits remain huge, that the outlook is not getting any better, that Trump's bill is certainly not going to reduce the deficit and will probably increase deficits and the debt. I think that's kind of most of the projections. And even if it just is neutral, it still means we're on a fiscally irresponsible course. But Trump and his Treasury Secretary have basically put out there that they're considering financing a lot of the debt in the Treasury bill market, and they'll then wait until they can replace Powell with somebody more to their liking, which might be Besant for all we know. And then the new Fed chair will lower interest rates, and then they'll refinance everything in the long end. So that's kind of the game that's being played right now.
I mean, it's a game. If it is a game, there is one side that's predictably the winner. There's a reason why they say don't fight the Fed. Ed, how much of the current environment right now of this vigilantism or lack thereof or ineffectiveness of it is because there is a new operating structure in the markets where the Fed is way more active and has way more firepower than any of the bond vigilantes could ever hope to combat?
Sure. Well, I think not only that, but the Treasury is playing the Fed's game, right? They may do yield curve control, which means issuing more in the bill market, less in the long end, keeping the long end down until they get a Fed chair that's more to their liking. But Rick Santelli had it absolutely right. We had a very similar environment in the late last year where the Fed lowered the Fed funds rate by 100 basis points. And at the time, I said I didn't understand why they were doing it. The economy seemed resilient to me, and it proved to be resilient. And you know what happened? The bond yield actually went up by 100 basis points. So I think we may be looking at that kind of scenario now, where, as Rick suggested, if the Fed were to lower interest rates, or if the Treasury were to play this game with issuing more bills, the bond market might be very concerned that we aren't out of the woods when it comes to tariff-related inflation. And imagine that the Treasury does its thing, or the Fed somehow decides to lower interest rates because the employment number is weak tomorrow. Put it all together, and the bond market might react badly, in which case we'll be talking about the bond vigilante some more.